We're starting with chapter 23, cash flow forecasting and working capital. So why cash is important to a business? Cash is a liquid asset. This means that it is immediately available for spending on goods and services. So we call cash a liquid asset because it is always available at any point in time that we want to spend it. That's why it's liquid. And it's the most liquid asset anyway. Do you ever run out of cash? Have you ever been unable to pay for goods which you need to at one particular time because you did not have enough cash? Have you ever borrowed money or incurred bills which you cannot immediately pay? If you answered yes to any of these questions, you have already experienced a cash flow problem. In business terms, cash flow means the flow of money into and out of the business over a certain period, a certain time period. So an individual or a business would have encountered cash flow problem if it finds it difficult to pay for certain goods and services as at when due. So if a business has too little cash, or even runs out of it completely, it will face major problems such as, so what are the problems you could face when there is cash flow problem? Well, what are the problems you could face when you run out of cash? Number one, being unable to pay workers, suppliers, landlords, or government. You won't be able to pay taxes. You won't be able to pay your landlord for rent. You won't be able to pay your suppliers. You won't be able to pay your workers for their wages or salary because you're out of cash. Two, possession of goods and services will stop. In as such as you are unable to pay your workers, they will stop working. They wouldn't work. Three, the business may be forced into liquidation, selling up everything it owns to pay its debts. So you might go into liquidation, and liquidation means you are selling your assets to pay off for your liabilities. I think it's clear. So we go to what is meant by cash flows. What's meant by cash flows? How can cash flow into a business? That is cash inflow. Here are the five of the most common ways. The sale of products for cash. That means you are selling products for cash. That's the first point. The second one, payments made by debtors. Debtors are customers who have already purchased products from the business but did not pay for them at that time. That's another way you can make cash into the business. Borrowing money from an external source, sourcing for finance. That means you borrowed money, which can be a loan or an overdraft. The sale of assets of the business, for example, unwanted property. You don't sell you don't sell assets that you are using for the business. You sell the ones that are not useful, or maybe their economic lifespan is done. Investors, for example, investors can also put money into the business. So how can cash flow out of a business? One, purchasing goods or materials for cash, paying wages or salaries and other expenses in cash, purchasing non-current fixed assets, repaying loans. So why do we have cash outflow? That means why do we spend money in the business? That is the point they are making. You might spend money because you want to buy raw materials. You might spend because you have to pay wages or workers' salary. You might want to buy or purchase non-current assets like machinery, like equipment. That will make you to spend money. You might be repaying your loans. So that could also make you to spend. Paying creditors. Yeah, that also make you to spend. I think the point is clear. So go to cash flow for cycle. For cash flow for cycle, we're talking about how cash comes in and what is being used for in a business. First, cash needed. That's the first step, is that cash is needed to pay for what? To pay for wages, raw materials, rent. And as soon as this is done, these raw materials that are being paid for will be converted into finished goods. Then goods will be produced. As soon as goods are produced, then they will be sold. As soon as they are sold, payments are made. Then they recycle it again. They use that payment to buy more raw materials, and that's how it goes continuously. That's cash flow cycle. Yes. I think it's clear. So they said the diagram also, okay, now to this last paragraph, second to the last paragraph. The longer the time taken to complete these stages, the greater would be the firm's need for working capital and cash. So the diagram also helps us to understand the importance of planning for cash flows. What would happen in the following situations? So if you are able to complete the cycle in time, then you won't have problem about cash flow. But if you are unable to complete those cycles in time, you will have problem of cash flow. Do you understand why or not? The cash flow cycle.
Yeah.
If you are able to complete the cycle on time, you won't have problem of cash flow. Or if you are unable, then you have problems of cash flow. Why did we say so? If you are unable, you might sell to your customers. They didn't pay it on time. You would not have money to pay your suppliers. There's cash flow problem. You might not have money to buy raw materials. There's cash flow problem. You might not have money to pay your rent. Cash flow problem.
They might not produce at the time. Or sell at the time.
Yeah. So if any of the stage is not quickly completed, then there's a problem.
Yes.
Is it clear? So if a business did not have enough cash at stage one, not enough materials and other requirements could be purchased, and so output and sales would fall. You won't be able to, when you don't have money, you won't be able to buy raw materials. Then you won't be able to produce. Output will fall. So if a business insisted on its customers paying cash at stage 4, because the business was short of money, it might lose the customer to a competitor who could offer a credit. So if you insist that your customers will pay at stage 4, where you have to collect the cash, they might get angry and stop buying from you. You might start buying from suppliers or businesses that offer them credit. You're losing customers.
Okay, yeah. There's pressure there.
To pay on time. If a business had insufficient cash to pay its bills, such as rent and electricity, it would be in a liquidity crisis, and it might be forced out of business by its creditors. These 3 examples illustrate the need for managers to plan ahead of their cash, for their cash needs, so that the business is not put at risk in these ways. You get it?
Yeah.
What cash flow is not? Do you get it now?
Yeah.
What cash flow is not? So what cash flow is not? So cash flow is not the same as profit. This is important. This is an important distinction. So cash flow is cash in and out, money spent and money paid out, or money spent and money received. That is cash flow. It does not mean profit. Though, at the end of it all, cash inflow, which is part of our revenue, cash outflow, which is part of our expenditure, would bring about profit. So, there's a clear difference between the profit made. Okay, let's just go down. Yeah, they said, okay, we need to read those things. Oh. What cash flow is not? So cash flow is not the same as profit. So this is an important distinction. We have a case study, which I think we need to go through it. It's a Good Hope Enterprises Limited records the following transaction over the month of June. Goods sold to customer, that's total revenue, which is 40,000. Cost of goods sold was 15,000, which was paid for in cash. 50% cash, 50% on 1 month on credit. So that means 20,000. 20,000 was paid and 20,000 were owed. That's what it means. So what was the gross profit in the year? The gross profit is always revenue minus cost of sales, which is 25,000. Assuming the business started the month with no cash, how much cash did it have at the end of June? At the end of June, the business would have a net cash flow, which is going to be cash inflow minus cash outflow. The cash inflow, the cash sales, which is 20,000, minus the cash outflow, which is the cost of sales, which is 15,000. So the net cash flow here will be 5,000 because the other 20,000 was not paid for. That is the point there. Do you get it? So there's a clear difference between the profit made by Good Hope Enterprise Limited in the case of study above and the cash flow over the same period. Why is the cash figure lower than the gross profit? The cash figure is lower than the gross profit because not all payments were made. 20,000 was received in cash. 20,000 wasn't received yet. So that's why the gross profit is lower than the cash figure. I think it's clear. That the cash figure is lower than the gross profit there. So because although all the goods have been sold, cash payment has been received for only half of them. So the customer buying the goods on credit will pay in later months. The important example leads to further questions. Can profitable business run out of cash? Yes. And this is the major reason why for businesses failing. It is called insolvency. Insolvency means you are unable to have cash with you. And one of the reasons could be delay in payments by customers, credit customers. They don't pay earlier. So if they don't pay earlier, what will you use in paying? You won't be able to do whatever you need to do with cash. That means you are insolvent. Do you get the point there? Yes. So they said, how is this possible? By allowing customers to too long a credit period, perhaps to encourage sales. When you allow customers to pay at a very long period of time because you want them to continue to buy from you. You'll be insolvent, and that might make you to close down your shop. Do you get the point?
Yes.
Purchasing too many non-current fixed assets at once. When you buy non-current, that is, purchasing of non-current assets is expensive. Like you are spending so much money on it. That means you are tying money down. So you won't have cash flow.
Yes.
When you purchase equipment, your money is being tied on that equipment. You might not have the opportunity to use cash for any other thing. That is the point there. Expanding too quickly and keeping the high inventory level. This means that cash is used to pay for high inventory levels. This is often called overtrading. When you overtrade, you have so much stock that they are not going to be sold within a short period of time. What's the point? Cash is being stored. That means you have so much cash. Because it has to be returned to cash.
Yes.
But now you don't have cash, which is the most liquid asset, as a result of you having a lot of stock on ground. Do you get it?
Yes.
So those are the reasons why a profitable business might still run out of cash. Clear? So we're going to the importance of cash flow forecast. We'll go to the importance of cash flow forecast. We have seen how important cash is to any business. Without sufficient cash to pay bills and repay loans, a business may be forced to stop trading by its creditors and banks. It is therefore very important indeed for the manager of a business to know what cash will be available month by month. That means month in, month out. A cash flow forecast can be used to tell the manager, one, how much cash is available for paying bills, repaying loans, or for buying fixed assets. So without cash, a business cannot run day in, day out. So it is important for managers to understand, to make a cash forecast. That means a cash estimate on what is going to come in and out of the business. So one of the reasons why it is important is that it helps managers to know the amount of money that's going to be spent on fixed assets at this point in time, or the amount of money that has to be used in paying bills or to pay loans at every point in time. Two, how much cash the bank might need to lend to the business in order to avoid insolvency. So because you are making a cash forecast, an estimate, that means you know the total amount of money you would be able to get from the bank that would not allow you, that would not make you to be insolvent. Because when you take too much from the bank, you have to pay too much interest. So that might stop you from having cash with you. So that's number two. Three, whether the business is holding too much cash, which could be put to a more profitable use. So because you have a cash forecast, so if you are exceeding your estimate, you would know that, no, you are having so much cash with you. So why can't you save it to enjoy interest rate or use it for other transactions? Do you get the point here?
Yes. What do you want?
So that's about that. Then we go to the uses of cash flow forecast. Are you there? For cash flow forecasts are useful in the following situations. One, starting up a business, running an existing business, keeping the bank manager informed, managing cash flow. So we're going to start with starting up a business. When planning to start up a business, the owner needs to know how much cash will be needed in the first few months of operation. This is a very expensive time. For new businesses, as premises have to be purchased or rented, machinery must be purchased or hired, inventory must be built up, and advertising and promotion cost will be necessary to make customers aware of the product or service. Many new businesses fail because owners do not realize how much cash is needed in the first crucial months. A cash flow forecast should help to avoid these problems. One of the reasons why we need cash flow forecast is that it allows us, especially new businesses, to know at least, if not all, figures that will be needed to run the business at that crucial month. Because one, it's a new business, you need to advertise so our customers are aware of the product. You need to buy equipment. You need to rent premises if you don't have one, or you need to buy one. So all these things are going to take cash from you. So it is important to plan for that. It is important to have an estimate of that amount that will be spent on all these things. If not, it becomes a problem for you. The business might fail. Do you get the point there?
Yeah.
So that's for a startup business. Then the second one is keeping the bank manager informed. Sometimes banks provide loans to businesses. That is certain. So, however, before bank managers will lend any money, they need to see the firm's cash flow forecast. This is particularly true of a new business, but also for existing ones. The bank manager will need to see how big a loan or overdraft is needed. When it is needed, how long the finance is needed, for and when it might be repaid. It is very rare for a bank to lend to a business unless a cash flow forecast is produced, which shows these factors. So the point here, so you have to keep managers, bank managers, they want to give you loan. Yes, they can give you loan, but you have to convince them with your business plan, with your cash forecast, with your financial records, so that they know that you can pay back. So that is why you need to keep managers informed. I think it's clear. You need to keep bank managers informed. The third one, managing an existing business. So you also need to have a cash forecast, because for even an existing business, you might run out of cash. So if without a cash forecast, then it becomes difficult for you to manage cash flow. Oh, if you have a cash flow, okay, for example, say, okay, in the month of May, you're expecting to see over maybe $3,000. And towards the end of May, 3,000 is not yet coming in. Then you know there's a problem, which you have to quickly make adjustment on. So they said, as soon as seen from earlier examples, it is not just newly formed businesses which need to forecast cash. Cash flows. Any business can run out of cash and require an overdraft, perhaps because of an expensive non-current fixed asset being bought or a fall in sales. Borrowing money needs to be planned in advance so that the lowest rates of interest can be arranged. Telling the bank today that a loan is needed tomorrow could lead to a bank either refusing the loan because of the poor business planning or charging high rates of interest. The bank will know that the business has little alternative but to pay this without informing the bank manager first. The bank would insist that the overdraft is paid immediately, and this could force the business to close. For an existing business, it's also important for you to manage your cash flow. And how do you manage your cash flow? By making a cash forecast. If not, it might be difficult for you to get. For example, you might have a fall in sales, but because you never planned for a fall in sales, which means with a fall in sales, your revenue would be short. Then maybe you need money for other things. You might have to go to the bank. So if you are just going to the bank, impromptu, the bank doesn't know that you never told the bank beforehand that you are coming for such facility. The bank would know that you have poor planning. As a result, they might not want to give you a loan. Or they charge you high interest, which they know that you don't have any other choice than to pay for. So they want to discourage you from taking it. That's why they're going to give a high rate of interest. Yes. So whatever the case might be, not going for an impromptu credit facility shows that you are not stable. You don't have a plan. That is the point. You get the point there? So that's why you need, as an existing business, to also make a cash forecast. And lastly, when you make cash forecast, that allows you to manage your cash flow. Money coming in, money going out, you'll be able to manage it. So you would know if you have to quickly talk to your creditors that, oh, you won't be able to pay back. Or sometimes to manage your cash inflow, you might not need to manage your cash flow, you might not need to pay your creditors. So if you are planning not to pay your creditors on time, that allows you to have more cash to do other things. So, but this has to be planned for. Yes. You need to probably create awareness or inform your creditors on time that certain payments will not be made based on that invoice which was due. So that the creditor would also make its own plan. But if you don't tell the creditor on just the due date, you are not paying. That makes you to look untrustworthy. Do you understand? So for you to manage your cash flow, you need to make a cash forecast. Is it clear? So we go on. So how a short-term cash flow problem might be overcome. Are you there? Yes. There are several ways in which a short-term cash flow problem could be overcome. They are explained below. One, method of overcoming cash flow problem. One, increasing bank loans. You can increase your bank loan. And how does it work? With the bank loan, you have more cash injection. But what are the problems about getting the cash loan, a loan from the bank? You have to pay more interest. And if you are paying more interest, that is part of your expenses. It reduces your profit. Yes. And at the end of it all, you have to repay the loan. That's about increasing bank loan. Clear? Two, delaying payments to suppliers. When you delay payments to suppliers, it reduces your cash outflow. Yes or no?
Yes.
But the problem about it is that suppliers might refuse to sell to you the next time. Did you get it?
Yeah.
And another point is that you won't be able to enjoy cash discounts, which you are supposed to get from paying earlier. Do you get the second point there?
Yes.
The third point, asking debtors to pay more quickly or insisting on only cash sales. This will increase your cash flow in the short time. But customers might buy from other suppliers who offer cash credit sales.
Mhm.
Do you get it?
Yes.
The last one, delay or cancel purchase of capital equipment. That also reduces your cash outflow. But the problem is that the long-term efficiency of the business might not be intact because you won't be able to buy equipment that would increase your output.
Yes.
Do you get the point there? In the long term, a business with cash flow difficulties will have to take other decisions to solve the problem. This includes one, attracting new investors who can inject additional capital. Do you get it?
Yeah.
But there, you'll be losing ownership. Do you get the point?
Yeah.
Two, cutting costs and increasing efficiency. But will this be popular with employees and will this be popular with employees and could protect product quality and could product quality be affected? So when you are cutting costs,
Yeah.
cutting costs means it will affect either employees or the product itself.
Yeah.
So if it's about the product, you are thinking about getting cheaper raw materials. What about the quality?
Mhm.
If you are thinking about employees, in the long term, a business with cash flow difficulties will have to take other decisions to solve the problem. In the short term, it's easy. You can take a loan, but you have to pay interest. You can delay creditors' payment, but you have to remember that creditors might not trust you again.
Mhm.
You might insist on credit. You might insist on cash payment on loan. But note, the problem is that it will increase your cash inflow, but some customers will not buy from you, especially if they have your competitors allowing them credit.
You lose customers.
You will lose customers. But for the long term, these things are not applicable. So for the long term, the first thing you could do when you have cash flow problem in the long term is one, attract new investors. But when you're attracting new investors, it means you'll be losing ownership of the business because they are going to inject capital, but in return for your ownership. That's it. Do you get the first point?
Okay.
The second one, cutting cost and increasing efficiency. So in cutting cost, you have to think about employees and the quality of the product. So if you are thinking about employees, if you are cutting costs and you are reducing wages of employees, how are they going to feel? Do you think cutting their wages or cutting the benefits that they used to get, do you think they're still going to encourage them to do more? What about their motivation? If the motivation falls, if the motivation is going down, then productivity will fall too. So you have to think in that aspect, in that respect. And for quality of the product, you are thinking about buying cheap supplies or cheap raw materials. What about the quality of those cheap raw materials? Because when it is cheap, the quality might be free. The quality might not be there. So that's another point there. The third point, developing new products that will attract more customers. This could take a long time and needs cash in the short term to pay for development. So another way in which you can solve your cash flow problem is to develop new products that customers can be attracted to buy. But this is the long-term thing. It might take time. Do you get the points there?
Yeah.
So that's how to solve short-term or long-term cash flow problem. For the short term, we said it earlier, you can stop credits of customers. It will increase your cash inflow, but some customers will not be able to buy from you. You will lose customers. You can take a loan from the bank. That increases your cash inflow. But the problem about taking the loan from the bank is that you have to pay interest. And at the end of it all, you still have to pay back the loan. You can delay creditors. You can delay your creditors.
Right.
The supplier can delay their payment. When you do this, it reduces your cash outflow.
Yeah.
But the problem is that your creditors might not be happy and they might not want to sell to you. It's for you. They might not want to sell again or give you a trade credit in the future. I think it's clear. So that's all about how to solve long-term and long-term and short-term cash flow difficulties. So we go on.
هذا شوية
So the concept and the importance of working capital. Yeah, when we talk about working capital, this is the money that the business use in running the day-to-day activity of the business.
Yes.
Okay. Sorry. Concept and importance of working capital. Like I said earlier, the working capital refers to the amount of capital which is readily available to a business. So it is what the business use in running its day-to-day activity.
Yes.
So that is working capital is the difference between resources in cash or readily convertible into cash and the short-term debts of the business. So working capital, the formula for working capital is current asset minus current liability, because current assets are those things that can be easily turned to cash. These are your current assets. The current liabilities are those debts that you have to pay within a short period of time. So those debts that you have to pay within a short period of time, you have to pay it with the current assets. That's working capital. I think the point is clear.
Yeah.
So the working capital is always the lifeblood of a business. Having enough working capital assists in raising the credit reputation of a business. No business can run effectively without a sufficient quantity of working capital. It is crucial to retain the right level of working capital. So why do we call it the lifeblood of the business? We call it the lifeblood of the business because without it, we cannot do anything as a business. We cannot operate. So a business enterprise with ample working capital is always in position to take advantage of any favorable opportunity, either to buy raw materials being offered at a discount or to implement a customer special order. So if you have enough working capital, so whatever business opportunity that comes to you, you'll be able to use it. Maybe there's a discount given for a specific period of time. If you don't have cash available, you won't be able to enjoy the discount.
Yeah.
So having cash with you, having working capital with you, gives you opportunity to explore. That is the point there.
Yeah.
So working capital may be held in different forms. So how can you keep working capital? One, cash is needed to pay day-to-day cost and buy inventory. So one of the reasons why you have to keep working capital is because you need to buy stock, inventory every now and then. So you need cash for that. That's the first point. Two, the value of a firm's debtors is related to the volume of production and sales. So to achieve higher sales, there may be a need to offer additional credit facility. So you need to produce more so that you can sell on credit to a lot of customers. Because as soon as the customer confirm that they are buying these things on credit from you, then you can count it as part of your cash.
Mm-hmm. Yes.
Do you get it?
Yeah.
And for you to be able to do that, for you to increase your output, you need to have cash with you. The third one, the value of inventory is also a significant part of working capital. Not having enough inventories may cause production to stop. On the other hand, a very high inventory level may result in high opportunity cost. So the problem about the value of inventory, the value of what you have is also part of cash because it can be turned to cash.
Mm-hmm.
You need to have enough. But having a lot, much more, becomes a problem because you are tying money down. So the much you need to have is the much that is needed for those customers. So as soon as a customer comes, they are able to buy. That is the much that is needed.
Yes.
So you don't have too much or too little. So that is why it's important for you to do a cash forecast.
Yes.
Or a sales forecast, sorry.
Sales forecast.
That is what determines the stock that you're going to sell and the stock that you need to keep. Do you get what sales forecast is here? There's a sales forecast which talks about prediction on what you have to sell.
Mm-hmm.
So if you are predicting to sell 10,000 units, that means you could have 9,000 or 11,000 units of stocks with you. If you're having too little, you won't be able to meet up with the orders. If you're having too much, you are tying money down. It becomes a cash problem.
Okay.
Are you sure you get it now?
Yes.
So that is not cash flow forecast. It is sales forecast. So with a sales forecast, you'll be able to predict at least the quantity needed to be sold so that you won't have a lot of stocks which are not going to be sold or less that becomes a problem which customers get disappointed at. Do you understand?
Yes.
No, is that all?
Yeah.
So the overall success of a business depends upon its working capital position. So it should be handled properly because it shows the efficiency and financial strength of a company. So your strength, the efficiency of a company is dependent on your working capital, because with your working capital, your stocks are intact. With your working capital, you can pay your employees. With your working capital, you can pay your debtors, your creditors. And with all these, it means you're going to have a good reputation as a business. So that's why it's the lifeblood of the business. So that ends the chapter. So the next chapter is what, please?
Income statement.
Income statement. Okay. Thank you.